Okay, so every time the Indian rupee takes a tumble against the US dollar, you see the headlines, right? They're everywhere, screaming about a weakening economy, rising prices. And look, it's totally natural to feel a bit of that panic. But what if I told you there's a whole other side to this story? So, this is the big question on everyone's mind, isn't it? Is India actually in trouble? It feels like it should be a simple yes or no, but trust me, the world of currency economics is, well, it's a lot more complex and honestly, way more interesting than you might think. So, in this explainer, we're going to dig way deeper than those scary headlines. We're going to look at who actually wins, who loses, and get this, a surprising strategy that might completely change how you think about the falling rupee. All right, let's jump right in. To really get the full picture, we've got to start with why a falling rupee feels like such bad news for pretty much everyone right off the bat. Okay, so picture this. Let's say you're an importer and you're buying something worth $1,000. When the exchange rate is 77 rupees to the dollar, you're paying 77,000 rupees. Simple enough. But then, if the rupee slips to 78, bam, you're suddenly shelling out 78,000 rupees for the exact same stuff. That's a direct hit to your profits just like that. And that effect, it doesn't just stop there. It ripples out across the entire economy. I mean, think about it. India imports a ton of stuff. We're talking about essentials like petrol for our cars, the electronics in our pockets, even the raw materials for our factories. So when all of that gets more expensive to bring in, where do you think that cost goes? Yep, it gets passed right on to us, the consumers. And that, right there, is how a falling rupee directly pumps up inflation. But here's where it gets really interesting. A falling rupee isn't a one-sided story at all. See, for a completely different group of people, this very same situation, well, it's actually fantastic news. So let's just flip that whole scenario on its head. Now you're an exporter, selling $1,000 worth of goods to someone overseas. When the rupee is at 77, you get 77,000 rupees. Nice. But when it weakens to 78, you're now getting an extra 1,000 rupees in your pocket for the exact same sale. For our exporters, a weak rupee is a good thing. It means more income, better profits. Okay, so that's the logical next question, right? If some people are actually winning here, why is all the talk, all the headlines, almost always so negative? Well, the answer comes down to a massive, massive imbalance between what India buys from the world and what it sells. This imbalance has a name. It's called a trade deficit. And here's the absolute key. India imports way more than it exports. So while our exporters get a nice little boost, the negative hit we take on our massive import bill is just so much bigger, it's not even close. And the scale of this problem is, honestly, it's staggering. Get this. In just 1 year, India's trade deficit jumped by a massive 87.5%. It skyrocketed from $102 billion all the way up to $192 billion. So you can see why when the rupee weakens, our country's total import bill just explodes. This puts a ton of pressure on prices, on businesses, on our foreign currency reserves, and that explains why it feels like a full-blown crisis every single time. It seems like an open and shut case, doesn't it? Well, not so fast. Okay, so up to this point, the story seems pretty simple, right? Falling rupee equals bad news. But this is where the whole narrative gets flipped on its head. What if? What if this fall isn't just a crisis we have to endure? What if, in some ways, it's actually part of a strategy? I mean, check out this quote from a major economic analysis. It captures this really surprising viewpoint that a lot of economists actually hold. They argue that fighting to prop up the rupee might be the completely wrong move. The idea is that letting it fall in a controlled way could be exactly what the Indian economy needs right now. So why on earth would they say that? Well, let's break it down. There are actually 4 really powerful arguments for why letting the rupee weaken, again in a controlled way, could be a very smart long-term play for India. Okay, here they are. First, it helps make our stuff more competitive on the global market. Second, it's a way to push back against global trade tariffs. Third, it fixes a problem we've had for a while, where our rupee was actually too strong. It was overvalued. And fourth, it just eases some of the financial pressure on our central bank. All right, let's zoom in on that third point for a second, the whole overvaluation thing. Economists have this tool called the Real Effective Exchange Rate, or REER for short. You can just think of it as a reality check on a currency's true value. A score of 100 is like the sweet spot, perfectly balanced. But if your REER is over 100, it means your currency is stronger than it should be, and that makes your exports more expensive for other countries to buy. And for years, India's REER has often been sitting above 100. So a controlled fall on the rupee actually helps fix this, bringing its price tag back to a more natural and competitive level.
So this is really the key takeaway here. We have to understand the difference between a sudden, uncontrolled currency collapse, which is, always bad news, and a gradual, controlled depreciation, which can actually be a pretty powerful economic tool.
And this brings us to the core trade-off, the classic short-term pain for long-term gain situation. In the short term, yeah, there's absolutely pain. Imports cost more, inflation goes up, the trade deficit gets worse. But the potential long-term prize? A much more competitive economy with booming exports, a boost to our own manufacturing here at home, and a currency that's actually priced correctly. But, and this is absolutely critical, this strategy doesn't just work by itself. A weaker rupee isn't some magic wand. All it does is create an opportunity. To turn that opportunity into real, lasting growth, it has to be matched with some very smart, very decisive action. So what's the game plan? What does India actually need to do? Well, first, we've got to aggressively push our exports to take advantage of this new price advantage. Second, we need to cut down our dependency on imports, especially from China. Third, we have to use this moment as a catalyst to boost our own domestic manufacturing. And finally, the Reserve Bank of India has to play its part by making sure this fall is gradual and predictable, not a roller coaster ride. So the next time you see those headlines about the rupee falling, you'll know there's so much more to the story. It's not just something to be afraid of. It's a really complex economic moment with both serious challenges and incredible opportunities. The real question we should be asking isn't just, why is it falling? But are we using this fall to build a stronger, more resilient economy for the future?